This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making from two Canadians. We're hosted by me, Benjamin Felix, Chief Investment Officer, and Dan Bortolotti, Portfolio Manager at PWL Capital.
All right, welcome back.
Yeah, so I want to do a quick mention before we get into the episode that August 2nd was the 7th anniversary of the Rational Reminder Podcast.
Wow.
It's kind of cool. So I thought I'd share some quick stats there. The YouTube channel has, as of July 30th, when we're recording, gotten 2,700,072 views. Wait, is that right? 2.7 million views. And it's been watched for 762,000 hours.
That's a lot of hours.
Which is around 87 calendar years of watch time. Kind of crazy. And now that it's also worth noting there that the YouTube channel didn't have video content. We would post the audio without any video up until episode 101. So Ken French episode 100 was the last episode with no video. So that's about 2 years into the podcast's existence that we started posting video. So all that, most of those views came after we started posting actual video. And it's interesting. I've heard people say over the years that they never thought they'd be interested in watching the video, and they were always an audio listener, but for whatever reason, they decided to check out the video of an episode, and then they never went back. I always thought that was just interesting. I personally don't watch any podcasts. I listen to podcasts. I would have trouble keeping a video on because I'm usually doing something else when I'm listening.
Yeah, and I guess now if you have like the YouTube Premium, you can turn off the video on your phone and still listen.
True.
But again, it does beg the question, why not just listen to it on your podcasting software? But I guess they just like to look as well.
Yeah, I'd like to look at us. I don't know. It's weird to me. I don't like looking at myself. But that you can actually see in the data. I wish I had prepared the data that the mix of audio and video has changed over time, where the video has become an increasingly large portion of the overall consumption of the podcast. Anyway, the audio podcast has been downloaded 8.3 million times since inception of the podcast 7 years ago. The Rational Reminder community, I can't remember when that started, but it was years into the podcast existence, has just under 12,000 users and generates around 500,000 monthly page views within the community. So that's all pretty cool. And I did, reflecting on Rational Reminder, I wanted to give a shout out to you, Dan, because your Canadian Couch Potato podcast, it kind of created the market for this type of content in Canada. And then when you stopped doing your podcast, Rational Reminder really just filled a void that you left.
Yeah, thanks. No, it's nice of you to say. I mean, it's true. It was kind of early to the game. We had some really great social media consultants with us at the time. I think my podcast launched in 2016. Does that sound right?
Yeah, I think so.
Which, is again, like relatively early. I mean, it seems like podcasts are everywhere now, but they weren't 10 years ago. So it was kind of new, and I really enjoyed doing it. But as you know, Ben, how much work they are to do, it was kind of getting in the way of my client work, and so I had to give it up. But I'm really happy to have kind of come full circle and joined you here.
Yep, very cool how it did come full circle like that.
Mm-hmm.
Okay, so that's it for the 7th year anniversary of Rational Reminder. I do also want to mention before we get into the episode that one of the coolest parts about our professional lives, or my professional life, you've been not so involved with this part, Dan, post One Digital, is that we get to meet with Canadian advisors who are interested in joining PWL. I didn't realize how kind of fun and interesting that would be. But the really incredible thing about it is that largely due to this podcast, we're meeting with advisors who are completely aligned with us on investment philosophy, planning approach, and other intangible stuff like just culture and the feel of the people, the kind of personalities of the people. So that's been incredible because those people are now, because we're saying that we're interested in acquiring practices and having other advisors join our firm, people are reaching out and wanting to talk. And so I get to spend time with them, and it's just been really cool.
Ben, what's your sense of some of these advisors that you're talking to? Are they people who, want to be using an approach like PWL, but have not been able to do so at the firm they're currently at? Or are they people who are kind of already doing something similar to what we're doing and just looking to be part of a bigger organization?
Yeah, it's the second one so far. And I think the first group probably does exist, and we'll talk to them eventually. The second group, though, is much cleaner in terms of having a team or a firm like that transition into PWL. And so the conversations we've had that have advanced so far have been with people who are honestly mirror images of, like, you take any advisor team from PWL, any individual advisor team, and these teams are a mirror image of that. They're using the same portfolios, same approach to planning. In many cases, they're using our tools, like they're using our expected return assumptions and our CPP calculator and all that kind of stuff. They're typically using the same financial planning software that we're using. So they're really teams that are like, they could be here already. They just don't have PWL email addresses yet.
Right. Excellent.
Yeah, so that's been cool. Now, one thing that's been interesting is one of the hangups that some advisors have about joining a firm like PWL is that they don't feel like that they can be an employee, which is interesting. Now, I've never felt like an employee personally at PWL, but I can see how that would be perceived because PWL is a bigger organization. Ben Wilson, who's our head of M&A, we'll have him on the podcast eventually. He posted on LinkedIn about this, and I just thought it was an insightful post, so I wanted to share quickly. So he's noticed what I just said, that a lot of advisors who he's talking to, because they're effectively self-employed small business owners, they don't think that they could fit into an environment where they are an employee. And Ben says that they worry that joining a larger firm means giving up their autonomy and their flexibility, or even their identity, if they identify with their business or as being a business owner. But what Ben says is that with the right fit, it can actually be the opposite, because you're no longer alone in the trenches, is what Ben wrote. You can go on vacation knowing your clients are still getting top-notch service from like-minded advisors. Like, think about what I said a minute ago, that a lot of these people we're talking to are mirror images of teams that we already have at PWL. And so if someone goes on vacation, their clients are getting served by people who are kind of mirror images of themselves on client service and philosophy and all that kind of stuff. Ben writes that you don't have to juggle business management, tech, HR, research, and operations on top of doing client work. So it frees up your time from those types of tasks. Instead, you get to focus on financial planning, advising, and making an impact in the lives of clients. And then Ben says, perhaps most importantly, you get to collaborate with high caliber peers who challenge you, support you, and share your commitment to doing what is best for clients. Yeah, so that's kind of it. But his main point is that the right partner, like joining the right firm, doesn't take away your independence. It actually kind of does the opposite. It gives you breathing room. It amplifies the impact that you can have. And Ben says it can help you do your best work without burning out. I just thought that was insightful.
Yeah, burning out is definitely a risk in this business, right? For people who, do have a big book of business and are very high touch with clients, as all of our advisors are here. Yeah, you got to make sure that you have a good team and that you're able to delegate, and that you don't try to take on more than you can comfortably handle. That's not going to be best for clients either, as well as for yourself. So
Totally. And I do know a lot of people in this business that they've got decent books, but it's them and maybe one support person, and it's tough, because if you do want to deliver that level of client service and you're the only person available to do it, it's not so easy to find balance. Anyway, so that's my PWL pitch for the day.
all right.
Ready to get into the main topic?
Yeah, let's do it. So we've got some, I think, a really interesting topic today, where we're going to look at some nuggets of investing wisdom that we've compiled and that some listeners have suggested. And yeah, so let's jump into that.
Yeah, so this came from a thread. The idea for this episode came from a thread in the Rational Reminder community, where someone had said, I think it was titled, "What are your favorite investing mantras?" And they started with a few of their own. They kind of seeded the topic, and then a whole bunch of people contributed. And it became a really cool discussion. And I was reading lots of quotes that I'd seen before and thinking like, oh yeah, that's a good one. And then reading lots that I hadn't seen before. And it's like, oh wow, that's a really good one. I want to remember these and kind of compile the ones that I really like. So I did that. I took a bunch of these quotes and put them into put them into a document and wrote why I think they're important, which I think is like one thing to have the quote and then another thing to contextualize it in terms of how investors can use it. Okay, so let's jump in here. So some of the most valuable wisdom in investing exists in the form of short quotes that distill hard-earned experience and knowledge from expert practitioners and academics into a handful of words. So what we're going to do is go through a bunch of these quotes, tell you why we think they're important, and these are quotes that I think every investor can and should learn from. We'll read the quote, explain why we think it's important, and how it can be applied to everyday financial decisions. I do want to mention that they're not in any particular order of importance. They're not ranked. They're all important for different reasons at different times in an investor's journey. All right. So for the first quote, and I think this is one that often gets underappreciated in investing, which is saving. Like saving is a necessary precondition for investing. And for a lot of people, especially early in their saving and investing career, saving is going to be far more impactful and more reliable at building wealth than searching for higher investment returns. I think it's common for people to want to find, the best stock or the best option strategy or factor tilt or whatever, but they're saving, nothing, or they're investing $1,000. Not to talk down to people who are investing $1,000. That's a great place to start. But when you have $1,000 to invest, your savings rate is going to be much more important than your investment returns, unless you can win the lottery, which you probably can't.
Right.
Yeah.
No, I was just going to say, so look, what's the quote here?
Yeah. Sorry. Big build up there.
Yeah.
So
I know you're getting to it.
So I think that this idea of saving being important is captured by a quote from George Clason, who's the author of The Richest Man in Babylon, and really popularized. And I knew the quote from Dave Chilton, but when I went and I actually posted this one in the Rational Reminder community and attributed it to Dave Chilton, and someone said, actually, that's from The Richest Man in Babylon, which predates The Wealthy Barber by many decades. So the quote is, "Pay yourself first."
3 words, but so much wisdom.
Right? Yes. And it's really just like to have any shot at building wealth, while fighting off all of the temptations to spend, which we're surrounded with every day, you have to save. You have to pay yourself before you have the chance to give in to the societal, biological, and psychological pressures that lead many people to overspend. So that's the quote.
Yeah, I think this one, it really, you can take it in a lot of different directions, but it has so much resonance. I think it was Mark McGrath who did a piece in the Globe not long ago about top-down budgeting, or this idea that rather than worrying about what you spend, and even more what you spend on individual categories, how much you spend on restaurants and entertainment and whatever, start with the savings part. And if you get that part right, it doesn't really matter what you do with the rest of it. Now, what does that mean? You need to have some kind of specific financial plan. You can't just say, I'm going to save $100 a month and say, that's all I need. Like, you need to do some kind of planning to see how much you need to save. But people might set a target. They want to max their RSP, or if you can afford it, max the RSP and the TFSA, whatever it is. And, if you're able to look after that by automating it, having it come off your paycheck, you don't really need to fuss too much about what you spend. You can spend what's left, and it doesn't really matter what you spend it on. So nobody likes, I don't think anyway, nobody really loves budgeting and itemizing every penny they spend. And with this kind of pay yourself first strategy, you don't really need to do that.
Yep. I am not a fan of budgeting. Some people are.
Yeah, neither am I.
I don't get it. I don't get how that can be like fun or enjoyable. Some people are into it. But I do the same thing. I decide how much I want to save or need to save, and then don't worry about how I spend the rest. The only thing to be cautious of, I guess, is going into debt. Because if you save the amount that you want, but also have a line of credit and you're building that balance up every year, that can be problematic.
For sure.
So I think, like you said, Dan, automating that is huge. If you can set up payroll deductions through your employer, that's great. Not all employers offer that. PWL does, which is great. But if you can't do that, then just setting up an automatic contribution into your investment or retirement accounts is a pretty close approximation. But if you can get payroll deductions, that's pretty good. Now, in terms of how much to save, like you mentioned, Dan, that's got to be based on some kind of financial plan or something like that. The Wealthy Barber and I think the Richest Man in Babylon also suggest 10% of your income always. Now that's is a tricky one. If you asked an economist, they would generally disagree, I think, because if you look at the life cycle model, you'd probably be saving less early on in your career when you have less income available. And then as your income rises through your career trajectory, you'd start saving a higher proportion of your income. And overall, it gets you to a place where you can fund your future retirement consumption. And that's very different from 10%. Like an economist might say that you're sacrificing a huge amount of utility by saving 10% of your income when your income is relatively low. You could be enjoying your life more. Anyway, I don't have a super strong opinion on this. I think the counter argument there is that if you don't start saving early, then you're not going to have the discipline to start saving later. I don't know. I don't know how you approach this with clients, Dan, but I don't have a super strong opinion.
Yeah, I think, honestly, for I don't love a 10% rule of thumb, because I would say that for people with lower incomes, that's a stretch. And if they
Right.
can save sort of 5 or 6%, that's probably very good. And if you have a very high income, you need to be saving more than 10%.
Right.
So I think it's going to depend a lot on your income. I would also say, and you kind of hinted at this with earlier in your career, it's okay to save a lot less than that if you're in your peak spending years and you've got
Right.
young kids and a mortgage.
Right.
And especially paying off a mortgage is increasing your net worth in a similar way to savings. And then again, as you get older, eventually, if you've paid that mortgage off, now you need to increase your savings, right?
Right.
If
Yeah.
15, 20% of your income was going towards your mortgage before and now it's paid off, you need to redirect that into a different way. So, look, rules of thumb are always problematic, but I think this one is really a much more personal decision than any rule of thumb can possibly help you with.
Yeah. I agree with that. And that would show up if you did a financial planning projection with proper financial planning software. That all of the things that you just said would show up. Okay, so that's pay yourself first, necessary precondition. Next, we have some quotes on investing. So investing it's as much a psychological endeavor as it is a financial one. It involves risk and uncertainty about the future, which are quantifiable to an extent financial issues. But doing it well, investing well, requires overcoming the countless behavioral biases that plague most investors. Ben Graham, who's one of the fathers of financial analysis and of the investment profession as a whole, said the investor's chief problem and even his worst enemy is likely to be himself. So I think this is really important for any investor to understand before they begin investing. Behavioral biases come in two main forms: errors in cognitive reasoning, called cognitive errors, and feelings or emotions that affect decision making, called emotional biases. Taken together, investors are really fighting an uphill battle to make good long-term financial decisions in the face of uncertainty and their own psychology. So that's the issue. And then I've got a couple pretty good quotes, I think, that address that, just about investor discipline. So we've got famous late investor and fund manager Sir John Templeton. He said the four most expensive words in the English language are "this time is different." This is really just a powerful reminder that regardless of the objective realities of a situation, narratives can easily sway people's investment decisions during extreme market conditions. When we have extreme positive returns, investors will clamor for explanations that not only justify the usually accompanying high stock valuations, but also justify their continued increases. Like at the peak of the dot-com bubble, people thought valuations would keep increasing because of the words this time is different.
It's
Same
very
as ARK when the ARKK ETF was just going through the roof and valuations were wild. It was the same thing, same kind of narrative. This time is different. Now, in both of those examples, many of the investors were buying stocks at historically anomalous valuations that like haven't been seen since. And as I mentioned, they were literally saying the words that Templeton is cautioning against. This time is different. The internet changes everything. AI changes everything. Robotics, whatever else the ARK thing was about. So that's on the positive side, when returns are good, I think the same thing happens when markets decline. Investors create narratives about why markets will not recover this time because of whatever is causing prices to decline, or why they'll go down further. Like if you think about COVID, how many times did we hear unprecedented? Too many times, an unprecedented number of times.
It's so funny that you said that, because when I first read the quote from Templeton about this time it's different, it's like you don't have to even use those words. You can just say it's unprecedented, because I've been hearing this, in so many contexts, right? I
Yeah.
mean, in April we heard it, right? People called us about, the Trump tariffs, and
Yep.
then you and I did some client communication on that front, right? And it was the same sort of thing. This has never happened before. COVID, it's unprecedented. We've never seen anything like this. And I guess,
Yeah.
it's true. We have not seen this specific circumstance before. But every market crash is caused by something that is unprecedented. And yeah, if we're going to react and change our investment strategy just because current conditions have not been exactly the same as this in the past, yeah, you're doomed to be changing courses, constantly.
Yeah. And we have a quote that addresses kind of that exact point in a minute. But I think that what you just said is really important to acknowledge, that when we do see extreme asset prices on either side, increases or decreases, it usually because something is different. Like the underlying cause and the accompanying
Yeah,
narratives, they're always unique, which is why they cause asset prices. We've never seen this before, and so asset prices do change because of that new information. But what doesn't change is the reality that like valuations matter, at least eventually. Like in COVID, valuations drop, expected returns increase during the dot-com bubble or the ARC thing. Valuations go really, really high, and then eventually they come back to earth. Valuations are kind of the closest thing to gravity in financial markets. They don't predict returns as well as, physics predicts the kinetic properties of an object in motion, but ignoring valuations on the basis that this time is different is, as Templeton expressed in his nice quote, generally an expensive mistake. Now, one way to stay, and this is the point that you brought up a minute ago, Dan, about changing strategies. Well, one way to stay grounded through periods of extreme market conditions in either direction is to have a lot of conviction in your investment philosophy. This is a quote from David Booth, co-founder of Dimensional Fund Advisors. He said, "The most important thing about an investment philosophy is you have one that you can stick with, is that you have one you can stick with." Now, the insight on this one is really deep. This is one of my favorite quotes. Financial markets have generally rewarded long-term disciplined investors, but many, if not most investors, sabotage their own returns by moving in and out of investment strategies or styles at precisely the wrong times. Even an objectively suboptimal, and I'm going to take a shot at dividend investing here, even an objectively
oh
suboptimal investment strategy like dividend focused investing might be the optimal investment philosophy for some people if the dividends help them to stay disciplined and stay invested. Uh,
yeah, I would argue that is the main value of
right.
dividend investing. I mean, I think we agree that it's suboptimal, but it's not a poor strategy if it's something that you can stick with. I mean, you could do an awful lot worse as an investor than buy and holding
Yeah,
dividend stocks over decades, right?
totally.
So, yeah, it doesn't need to be perfect. Nobody's investment strategy is perfect, but that is certainly one that has some behavioral advantages.
Yep. Now, and the hard thing about sticking with an investment philosophy is that any investment strategy, no matter how well founded its underlying philosophy is, can appear to be wrong or even stupid for long periods of time. Now, this probably ties back into the caution about this time is different too. I think ARC is again a good example. It's actually a really interesting example. So when ARC was on its big tear, when everyone started hearing about it, I heard from lots of previously disciplined index investors who were considering abandoning their entire index fund investment philosophy because the ARC narrative was so strong. And its manager, like Kathy Wood, she was taking direct aim at index funds and a lot of her commentary and a lot of the ARC literature. She had called index funds the most massive misallocation of capital in history. And she'd said that index funds are basically overweighting the old dying companies, which are at risk of being disrupted, while underweighting the companies that are going to disrupt them, which is what ARC was focusing on. So she was really taking direct shots at index funds, which was interesting. Now, for a while, and this is why it's hard for people to ignore stuff like this. It seemed like she was right because ARK just went to the moon. It was crazy. Completely smoked market cap weighted index funds. And then eventually ARK, the ARKK, the main fund, and I think most of those funds did eventually come back to earth, which is what tends to happen with funds like that. But the thing is, when you look at the timing of it, anyone who bailed on their index funds to chase ARKK's returns after the fund had posted its big returns, which is when everybody became aware of it, they got burned. And that was the Morningstar had a post on this a while ago where they looked at the dollar weighted returns of investors in that fund. Most investors weighted by dollars lost money because they piled in after the good returns and ate all of the bad returns. So that's typical. But the interesting thing is that investors in ARKK who truly believed in that investment philosophy and stuck with it from before Cathie Wood was all over the financial media when she was basically an unknown fund manager, if they'd stuck with it from then right through its eventual crash, which wouldn't have been easy, through until now, they've actually done fine. They've roughly matched, even slightly outperformed SPY, S&P 500 ETF. Now, I'm not condoning the ARKK strategy, to be clear, but my point is that conviction in any investment strategy, any investment philosophy, it's going to be tested over time, and the tests are hard. Like going through ARK's decline would have been pretty rough, I think. But as long as the philosophy leads to reasonably well diversified and low cost portfolios, I think having an investment philosophy that you can stick with through good times and bad is far more important. Like you said with the dividend strategy, Dan, it's far more important than having the perfect investment philosophy. Now, I do think that the well diversified and low cost qualifier is important. Some strategies like trading zero DTE options or YOLOing single stocks, those are likely to lead to bad outcomes. But if it's low cost, well diversified, and you can stick with it, it's probably okay.
You know, I think one of the most amazing findings that I remember coming across was in Meb Faber's book. I think it's called Global Asset Allocation. And, you know, he sort of tucks it away near the end of the book, but what he did was he back tested a whole number of model portfolios, kind of well-known ones, you know, the Yale University one and just a basic 60-40 Vanguard portfolio. And he did, some had commodities, some had real estate, some had, you know, alternative asset classes, and he tested them over about 40 years. What blew me away was that the variance in the portfolio performance over that full period was less than a percentage point.
Wow.
So, you know, and even he admits in the book too, because like this shocked me. I thought that they would be similar, but I didn't think they would be that similar.
Huh.
And this is exactly the lesson. The point is, nobody would have stuck to any one of those model portfolios. I shouldn't say no one, but only the most disciplined investors would have, right? Because during every decade, he looked at, you know, like I said, 40 some years, there were 10-year periods where some of them got absolutely smoked and others did phenomenally well. And then the reverse would happen. So if you just stuck with one and held it, you did fine, but almost nobody does that. They move, as you said, from whatever's hot to whatever's not, and back at the wrong time. And, you know, we just sort of cheat ourselves out of the benefits that come from long-term discipline.
Yep.
So I got one here that I just took from, you know, the sage himself, Warren Buffett. And the quote is, "The stock market is designed to transfer money from the active to the patient. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. And you have to be prepared when you buy a stock to have it go down 50% or more and be comfortable holding it." And the 50% number is what jumped out to me. And this is something I've used even in risk discussions with clients, because it unfortunately doesn't apply just to a stock. It applies to the market in general. An individual stock can go down more than 50%. But, you know, what we'll often say with clients is, you know, any equity allocation that you hold, even if it's very broadly diversified, you need to be prepared for the possibility that it could fall 50%. It did in 08, 09, right? This is not ancient history. And a lot of people are pretty shocked by that because they seem to think, you know, a bad bear market is 20%. And it's like, no, it can be a lot worse than that. And if you're not comfortable with that kind of volatility, and let's face it, many people are not, then you need to have a more conservative portfolio. Simple as that.
Yeah. Yeah, that's actually the direction I want to go next. So after settling on an investment philosophy, one of the most fundamental decisions that investors need to make is how to allocate their portfolios, like you were just saying. How much in stocks versus bonds, how much in the stock market of each country, which stocks within each country. So Bill Sharpe and Eugene Fama both have great, simple quotes that offer, I think, a pretty good starting point. Bill Sharpe said in a talk once in the early 2000s, I think, the global market portfolio is a good place for you to start. And that stems from Sharpe's work on the capital asset pricing model, which implies that the optimal risky portfolio for all investors is the global market portfolio combined with risk-free assets or leverage, depending on their risk tolerance. So that's an interesting starting point there. Now, what is the global market portfolio? That's another interesting question. State Street estimates that it is about 45% public stocks, 21% government bonds, 9% investment grade corporate bonds, and then a whole bunch of other stuff makes up the remaining 25%. There's like gold in there, high yield bonds. I can't remember, private equities in there, bunch of stuff. Now, we asked Fama about this when he was on, like private equities in the market portfolio. Should we actually invest in that? And Fama's answer was something like, it's not super obvious that we should because we just don't have good data on how that asset class behaves and the fees are really high. So just because the global market portfolio is there doesn't mean that we actually have to invest in that, but it's a really good place to start. And then Fama's quote kind of drives this point home. He says, you have to talk yourself out of the market portfolio. So his point, like the private equity example I just gave, is that there can be good reasons to be different from the global market portfolio, but it's important to be clear on what those reasons are and why they apply to you specifically. Another good one there is home country bias, which Fama has long been an advocate for. There are lots of reasons that we've covered in past episodes for why home country bias can make sense for an investor. And that's, again, a good reason to be different from the global market portfolio. But I think that as a starting point is a really nice idea because it takes a lot more conviction in whatever your strategy is to talk yourself from the global market portfolio into a portfolio of like 3 stocks than it does to talk yourself from the global market portfolio into a globally diversified portfolio of public stock and bond index funds.
Yeah, you can probably split that a little bit further, right? In the sense that I'm sure nobody is suggesting that most people should start their asset allocation decision at 45% stocks, right? I mean, it might be higher or lower depending on a lot of factors. So I don't know, like, given that the risk qualities in stocks and bonds are dramatically different, I think you can feel comfortable finding whatever relative mix you want between those two overall asset classes, depending on your specific situation. But once you break it down further and say, okay, if I'm going to hold 60% stocks instead of 45, let's start the discussion with the market cap portfolio. And we can go from there, but we're not going to do, 90% US stocks and 10% the rest of the world or some other highly concentrated allocation.
Yeah, that makes sense. Yeah. Even the stock bond piece is interesting. Like, why is the global portfolio so heavily weighted toward non-stock assets? There's a lot of reasons why.
Yeah, no, it's a good question. I mean, I guess too. I mean, businesses. I remember reading this number before, but I don't recall what it was. Like, what proportion of businesses are publicly traded versus privately owned? It's only a small portion of them are publicly traded.
Yep.
So the market portfolio, as you said, it private equity is in it, but
investable private equity. That's not
exactly like it does. That doesn't mean every individual small business on the globe, which is clearly uninvestable. So it's it really depends on how you break it down. But yeah, I was a bit surprised too that it's only 45% of the market portfolio by that measure.
Yeah. Yeah, so I think that I love that quote that you have to talk yourself out of the market portfolio. Like if we just take that as a starting point, and if you're going to be different from that, you have to have really good. I mean, factor tilting is another good one. Like if you say you want to have factor tilts, great, but you tilt away from the market portfolio. You don't buy the 50. Well, some people would say that you can do this, but I would say you have to have a lot more conviction if you want to buy the 50 50 stocks that load most aggressively onto the factors that you want exposure to. You really have to believe that you have the right factor mix to be that aggressive with your tilt as opposed to just slightly tilting away from the market portfolio. Now, even investors with a solid investment philosophy and asset allocation, and this comes back to the behavior stuff we mentioned earlier, they still often get nervous about market corrections. And they'll consider maybe going to cash to avoid the correction or delaying investing new cash until after the crash has happened. I see that a lot. So fund manager Peter Lynch said far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. I love that quote. It reminds us that while market downturns can hurt, and they for sure do hurt in the short run, the opportunity cost of not investing is typically far more expensive.
This one is absolutely true and really insightful. One of the things that I've always liked to say to clients, because every now and then you will hear them say, I've got some cash, but I'm going to wait until it feels like a better time to invest. I can say, I'm going to stop you right there. It never feels like a good time to put a big chunk of cash into the market, because if the market is strong, then you're going to fear it's got to come back to earth, right? This can't last forever. And if the market is weak, you will convince yourself that it's going to get weaker. I've seen this so many times that I have lost count. And so I say to people, like, if all you can bring yourself to do is dollar cost average, then do it. It's imperfect, but it's not a bad situation. And if it prevents paralysis, then it's a very good strategy. But if you think that you are suddenly going to feel great about putting a large amount of cash into the stock market, yeah, zero chance of that happening.
Yep. I've said before that if you feel really good about an investment, it's probably not a good investment.
I think that's good advice.
You're probably about to get scammed, or you're about to invest in something that has a low expected return. That's the thing, right? Like investing is inherently risky, and it is that fact that results in positive expected returns, and historically at least, it has resulted in positive realized long-term returns. But the problem is that investors are myopic. They worry about short-term fluctuations, even if they are themselves not short-term investors, and they're loss averse. You get myopic loss aversion, which makes it hard for investors to take a long-term view. Economist Jeremy Siegel, who wrote Stocks for the Long Run, he said, fear has a greater grasp on human action than does the impressive weight of historical evidence. I love that one. I'm probably going to say about all these quotes, but I love that one because I can tell you, as I've done in many episodes, over and over and over, what the historical data tell us about market crashes and recoveries, but that's not going to be helpful when there's fear in the air. And I think investors need to mentally prepare for those bad times, for those fearful times, and they need to your point earlier, Dan, they need to hold assets that they're not going to panic sell, even when things are not working out as they had expected. And I think a big part of that is that market declines are never abstract numbers on a screen. You don't just look at your account and say, oh, it's down 20%. Huh, would you look at that? There are these psychologically challenging times that stem from deeply emotional and uncertain events. Like the COVID-19 pandemic wasn't just a market decline. It was potentially the end of life as we knew it. Like I remember it because it was wild. The Great Financial Crisis was similar. It seemed like it was the end of the financial system as we knew it. Everything was falling apart. Society was potentially falling apart. Like it's crazy stuff like that. People were worried about civil unrest because of all of the asset price declines. So it's never just like, well, the market came down. It's the scary thing happening. I think narratives like that cause many investors to get out of the market in anticipation of worse things to come. But we know, and this comes back to Siegel's point, we know from the historical data that long-term investors, even those who endure, and I might even go as far as saying especially those who endure, market declines tend to be rewarded with positive long-term returns. So I think that's it. I mean, one of the reasons that investors struggle to stick with risky investments is that they don't really understand risk. So I've got some good quotes on that.
Yeah, the one thing I would add to this, and I don't for a second mean to suggest that that's coming through in the quote or in any of the commentary, but I do feel that some people, whether they're advisors or market commentators, tend to be a bit too dismissive of that fear. Like, we all understand that, yes, markets will come back, or historically markets have always come back. But, when you're dealing with people who have genuine anxiety about putting their life savings at risk, I mean, certainly we as an advisor have to take that really seriously and can't wave our hands and say, "Oh, the market will come back. Don't worry about it." Right? And I feel that often people are too dismissive of the conservative nature of some investors, and then it's really important for us to say, "Listen, I get it. I was afraid during COVID. I was afraid during the 08, 09 crisis too, and there's nothing wrong with that." The only thing that's wrong is if you don't match that risk tolerance that you have with your portfolio, right? If you feel that way, but you're still 90 or 100% stocks, that's a problem. But as long as you understand that in yourself and you say, look, I get it intellectually, that everything you said makes sense, but I'm terrified of the market all the time, then it's not only okay, it's essential for you to reduce your allocation to risky assets.
Yeah, I think that's true. I remember we talked about this in a previous episode, but I remember Jordan Tarasoff had those client cases where he had a similar difficult conversation where the client was very, very concerned. And Jordan found that keeping them in their current asset allocation as opposed to making it more conservative would add more lifetime value to their financial plan than any financial planning strategy that he could come up with. Because he had that asset allocation conversation and then subsequently had done a bunch of financial planning work around some other decisions they were making. And he kind of noticed that all of these other strategies that he was looking at, tax-related strategies and withdrawal sequence strategies and things like that, none of them could add as much expected lifetime value as maintaining their asset allocation. So yeah, but I remember Ken French, when we had him on, he talked about exactly what you just said, Dan, that you learn about a lot about yourself in a market decline. And if you learn that you can't handle as much volatility or downside risk as you thought, and you're really uncomfortable, that can be a great, even though, everyone says, well, you shouldn't change your asset allocation when a market downturn happens. Ken French said, I don't think that's right. You shouldn't try to time the market. But if you learn about yourself and realize that you were in a portfolio that was too aggressive, it's actually a great time to make a change.
Yep, I agree. And then of course, you need to make a note of that, because then when the market recovers, because people they'll come back and they say, you know what, I'm more comfortable with it now. Let's go back up to 70, 80% stocks. Like, nope, right? Like, as an advisor, that's where I would push back and say, no, I agree with the decision to go down because you demonstrated you don't have that risk tolerance, but we're not going back up now, right? Because now we're just playing the game. And but the analogy I like to use is, if people are afraid of flying, you can say to them, statistically, flying is extremely safe. In fact, it's more safe than driving a car, and it will get you where you're going faster. That has zero resonance with anyone who's genuinely afraid of flying, and you just have to respect that.
Yeah. Yeah, on this topic, and a bit of a tangent here, Dan, but we had a conversation with not a software provider, an intellectual property provider, maybe is the best way to describe them, but for a new risk profiling process that I think could be really, really interesting for PWL. So that's something I mentioned that on the podcast because one of the co-founders will, assuming things progress the way that I think that they will and should, the co-founder of that company will come on to talk about risk profiling and their academic work on that topic, and then we'll talk about this tool that we're looking at. But
Great.
Should give us more precision around estimating what people's actual risk tolerances are. Now, we're talking about risk as volatility, which is how risk is often discussed, or maybe the magnitude of short-term declines in asset values. And I think that's how people tend to think about risk. That's how most, like even academic papers, they talk about volatility as risk, or maybe as downside. I think regulators look at volatility as risk and as downside, but those are probably not the best measures of risk for long-term investors, which makes this weird tension between kind of regulation, behavior, and what's actually best for long-term investors. Now, there are some really great alternative definitions of risk that I think can help people think through long-term decision-making as opposed to getting caught up in volatility and downside. So Charles Ellis, who's been on this podcast, he wrote Winning the Loser's Game. He said risk is not having the money you need when you need it. Such a simple definition, but it captures the fact that risk can either manifest as the inability to fund short-term liquidity needs, which highlights the importance of planning for near-term expenses. For example, not investing money you need tomorrow to pay your rent or whatever. Or risk can manifest as the inability to fund long-term consumption, which captures the importance of saving and earning sufficient long-term returns to fund your inflation-adjusted spending in the distant future. I like that definition because it really captures both of those things in one simple sentence.
Yeah, it is interesting how often risk and volatility get conflated as though they're the same thing. And
right.
you know, that's Ellis's quote really hits on it, right? You have a portfolio that's 100% GICs. Well, there's no volatility. Is that risk-free? Of course not.
Right.
There's all kinds of risks inherent in a portfolio that conservative and that illiquid,
Yep.
but it isn't captured in, you know, even risk tolerance questionnaires and things.
Exactly. Yeah. So I like that quote. Then William Bernstein, who's the author of multiple books, on also actually a past guest in this podcast. He makes the second point from what I just said about Ellis's quote in this definition, where he defines long-term risk, specifically long-term risk, as the probability of running out of money over the decades. Which, to your point about GICs, Dan, you probably have well, depending on your spending rate, I guess, but you probably have a higher probability of running out of money in a portfolio of GICs than you do in a portfolio of stocks and bonds or stocks and GICs. So Bernstein's separating long-term risk, which I would say is what really matters to long-term investors, from short-term risk, which is less impactful in the long run, but it's also the thing that gives investors sleepless nights. Yeah, so I think that contrast between the two types of risk and how they can affect long-term decisions is really important, and I like how these quotes highlight it. Now, the tricky thing about this, or the funny thing about it, is that aversion to the short-term risk, to volatility and downside, likely exposes investors to more extreme long-term risk, like my GIC example just now. It's taking on the risk of more volatile, risky assets with higher expected returns that allows investors to expect the higher long-term returns. So Morgan Housel has another past guest. Wow. He's got a great quote on this. He says, volatility is the price of admission for higher expected returns.
Yeah, it's nicely said. I mean, I think it's right there. You know, we've said it before, right? The reason that stocks have high expected returns is specifically because they are so volatile. If they weren't so volatile, the returns would not be as high. I mean, it's
Right.
very simple, but, you know, difficult for people to kind of really take to heart. The one I've got here is sort of along the same lines, and the quote is from Ken Fischer. This is from his book, Debunkery. The quote is, normal annual returns are extreme. It is hard to get people to accept the degree to which that is true. And I think you need to unpack it here. The context of what he means here is, and I've used this quote when I do talks and things like that, and I speak to audiences and I say, you know, so to set it up, the numbers that he uses in the book are the average annual return on U.S. stocks. And this is an arithmetic average, I think, but from 1926 through 2009 was 11.7%. So I said, okay, let's say it's, let's round it down to 11. And if we say that normal is somewhere between 10 and 12 in that range, what number of times in the 84 years in that sample was the annual return on stocks somewhere between 10 and 12%? And no one gets this right, because people say, I don't know, a third, a half. If they're really pessimistic, they say a quarter. The answer is 5 times. There was 5 calendar years in that period where stocks were between 10 and 12%. And most other years, they were more than 20 up or losses of more than 10. So that's the volatility we're talking about. And that's why it's so important to stay invested, right? Because if you get out at the wrong time and you miss the double-digit gains, it's not like you missed the 10 or 11% return. You might miss 25 or 30 on the rebound. And so I don't think anybody truly appreciates, well, you sometimes will hear investors say things, right? Like, I want a kind of slow and steady return from stocks. I said, well, you will never, ever get that, right? You will most likely get a very good long-term return. It will not be slow and it will not be steady. So I don't think people truly appreciate the extent of that volatility. And that's why I love that quote and those numbers. I find them shocking every time I read them.
And it might suck for long periods of time. Like we said earlier that it can be easy to bail on a strategy because it sucks for a while. But like you look at U.S. stocks that had a lost decade of returns. That was a lost decade of returns. That's 10 years. Like,
yeah, and along the way, like even if it was a lost decade, right? Like let's say it was a zero return over 10 years. It wasn't like, well, it was up 1 and then down 1 and
right.
up 2 and down 2. It was like up 20, down 30, right?
Yeah.
And that like this repeat over and over and over with wicked volatility. And then at the end of it, it was net zero. That is a high price of admission, to use Morgan Housel's terms. So you've got to be prepared for that. And going back to the earlier quote about Buffett's, like if you're not willing to invest at least 10 years, and honestly, the annualized return of stocks doesn't really average or doesn't really get consistent until you go out about 30-year rolling periods. 30 years is a long time. And most of us do not have that kind of 30-year mindset when we invest. So it's a challenge.
They get more consistent in terms of the dispersion in the annualized return getting tighter, but the magnitude of the difference, like if you have a 1% difference in returns over 30 years, the magnitude of the ending difference is massive.
True.
There's still a lot of volatility, even at longer horizons.
Mm-hmm.
A lot of volatility in wealth outcomes, even if it's a tighter volatility or tighter variance in returns. So I think framing the risk as the probability of running out of money really does put emphasis on what long-term investors should really be focused on, which is earning sufficient long-term returns to fund their future consumption. And that can mean having to endure the risk. I would say it really does require enduring the risk of higher expected return assets like stocks. Not doing that can really impair your ability to meet your long-term goals. I mean, the Scott Cederberg research on this stuff really kind of drives that point home. Now, even if you have the right focus, and even if you do invest in high expected return assets, kind of like my large variance and wealth outcomes example a second ago, having the right focus doesn't mean you're going to get the outcome that you hoped for. So there's a couple of really good quotes on this too. Carl Richards, who's an author, he wrote The Behavior Gap. He's described a risk as what's left over when you think you've thought of everything, which is just such an elegant quote. It really captures the fact that models are not reality. No matter how good we think our models are, the future is unknown and unknowable. And that unknown and unknown future is what actually matters. That's what you care about, but you can't predict it. We don't know what's going to happen. I think theory and long-term evidence can help to kind of point us in the right direction, but they can't predict the future. And that just doesn't just apply to investments. I think life in general has a way of throwing curveballs at you, or curveball in my case, I guess. Making it hard to plan. That was a testicle joke. Making
I didn't get that one right away, but all right.
Which makes it hard to plan for everything. I came up with that on the fly. I wasn't planning on saying that. It just came to me. Economist Elroy Dimson, who I'd love to have on this podcast, he said that risk means more things can happen than will happen. And I think every financial plan has to account for the fact that we simply cannot know the range of future outcomes based on what has happened in the past or based on what we expect to happen in the future. Now, that doesn't mean we need to kind of tiptoe around and hope that nothing bad happens. But I think it does mean that we need to maintain a healthy respect for the fact that things will not always work out the way that we want them to, no matter how much data we base our decisions on.
Yeah, and I think it's an important point, right? Because we do sometimes get questions, from our clients. Well, what if we haven't prepared for all of the things that could come down the pipe? And it's like, we can't prepare for everything. We can prepare for risks that seem reasonable. I do think, though, that it's also worth appreciating that, there is an opportunity cost to trying to prepare for everything. So if you're going to build an ultra conservative portfolio, that would hold up against a risk that is, 1 in 200. Well, it means that 199 times out of 200, you will have made the wrong decision and will have compromised your lifestyle in some way in order to protect against the extreme case. So you need to find a balance. I mean, it's a bit like saying that Before anyone gets on a plane, they should be strip searched completely, because that's the only way we can assure that no one brings a bomb on the plane. Probably true, but would shut down air travel to the point where it would be impossible. And, your financial plan could be kind of similarly impaired if you try to protect against every conceivable risk. So there's a balance there somewhere.
Yeah. Yeah, definitely. I think there's another good quote on this from Roger Lowenstein, who's the author of When Genius Failed, which is a book that details the rise and fall of the hedge fund long-term capital management. We have not had Lowenstein on, but we did have Victor Hagani, who was one of the partners at LTCM. He was on Rational Reminder, and he talked a little bit about his LTCM experience. So Lowenstein, he wrote a book about that. He wasn't part of it. So Lowenstein is paraphrasing Eugene Fama's work on fat-tailed distributions, but he says in the book, as Fama put it, life always has a fat tail. Extreme events happen a lot more frequently than people like to imagine. The world life is not normally distributed. I think that poses challenges for financial models that don't capture fat tails, which is kind of what happened to LTCM. They had a model that didn't account for how fat the tails were in the assets they were investing in. But I think it also poses challenges for how individuals plan their futures. The nature of risk and uncertainty just make investing and planning for the long term inherently uncomfortable. Volatility being the price of admission for higher expected returns is a real thing, but financial product manufacturers and fund managers know that volatility and enduring volatility is a struggle, and they'll often cater their sales pitches to those types of concerns that investors have. So that leads me to another
GICs. We're
Well,
talking about you.
That's exactly the example that I have, actually.
Yeah.
I said structured notes, but it's the same kind of concept. And so this one's really important, right? Where it's like, okay, we know life has fat tails, so people are worried about the future. We know we can't predict the future. We know volatility is scary. And so banks and financial product manufacturers are like, well, hey, do I have something for you? But this is a quote from economist John Cochrane, who we've had on the podcast twice. He says in one of his papers, when having dinner with lions, make sure you're at the table, not on the menu. So we know financial markets are extremely competitive. If someone wants to sell you something, whether that's a stock, whether you're buying a stock on the stock market, or looking at a financial product, could be a fund or a structured note or a market-linked GIC, you need to ask yourself, why does this person want to sell me this product? What do they know that I don't? What's in it for them to sell me the product? What's in it for me as the investor? Are you entering into a mutually beneficial transaction, or are you about to be eaten alive by the lions? And there are a ton of financial products out there that cater to the fears and biases of retail investors in exchange for ridiculously high fees and costs, putting retail investors, I would argue, on the menu. Structured products are like the most egregious example because they use pretty significant complexity. Like we had a couple of academics on to talk about structured products, and it's like it's hard for them to do the analysis and figure out what does this thing actually contain? What are the underlying payoffs of this product? And so their argument, and I think the academic argument in general, is that financial companies use complexity to shroud high embedded costs, like really high, like 4 to 5% or even higher.
Yeah.
I think this is, yep.
No, I was just going to say it really comes down to kind of one promise that all of these products have in common, and that is stock-like returns
Right.
without the downside risk.
Yep.
And anytime you hear any product advertising something like that, it's impossible.
Yeah.
Just so you know.
Yeah.
And
nobody's taking the other side of that trade.
yes, exactly.
Right.
So volatility is the price of admission.
That's right.
You can't sneak in the back door.
No, there's no back door. Now that piece is really important to understand because fees and costs are one of the few things that investors can control. So John Bogle, the late founder of Vanguard, who is someone that I wish we'd had on this podcast while he was alive. It's a shame that we didn't. He's got this great quote. The grim irony of investing is that we investors as a group not only don't get what we pay for, we get precisely what we don't pay for. So he's speaking to the fact that in aggregate, investors have not benefited from paying higher fees to active fund managers who aim to beat the market. Instead, investors have underperformed roughly by the amount they paid in fees. So Bill Sharpe has referred to this as the arithmetic of active management. In aggregate, active managers must underperform index funds because both groups hold the market, but active has higher fees and costs. There is some nuance to that, which we've covered in past videos on kind of the how that changes a little bit when you introduce trading. But I think as a model, the arithmetic of active management still has really, really valuable insights, and it's more true than not. Basically, unlike other areas of life, in investing, it is really difficult to expect a better outcome by paying higher fees. It's in fact the exact opposite, which makes fees and costs a really important criteria in evaluating any investment.
It's one of the few activities that we do, right, where you don't get what you pay for. We, in so many endeavors in life, right, we think not only how much money but how much time you put into the activity generally produces better outcomes. But when it comes to things like stock picking and investment selection, it's just not true. And in fact, as you said, usually the opposite is true.
Yep. Yeah, I agree. You're right, both on fees, but also on time. The more time you spend, I didn't have it in here, but the portfolio is like a bar of soap. The more you handle it, the smaller it gets. That's
Yeah.
another good quote that's similar.
Yeah. And I hear it sometimes too when people talk about, indexing or passive strategy is fine for people who don't have the time to put in the work. And, this is where you look at institutional investors who use these strategies. And I think, do you honestly think that they don't have the time and resources to put in the work? Of course they do. The point is the work doesn't pay off, right? And I mean, we have just so much evidence showing that that's the case, but it's a myth that will persist, right? Because it's so counterintuitive.
Yeah. Yeah, it makes me think of that Barbara and Odine paper. I think it's called Trading is Hazardous to Your Wealth. But they found that in retail investor accounts, it's an older paper and an older data set. But the accounts that traded more had kind of like monotonically lower returns. So it's the same kind of thing. The more attention you pay to your portfolio, the worse you do.
Yeah, there's this apocryphal study. I've never actually seen it, but people have invoked it where they did some study and they found out the best performing investors were people who had died and their estate didn't know that they had an account.
The Fidelity study.
Yeah, my guess is that's not actually true, but it probably would be true if anyone actually did examine the data.
Yeah. I love that example. I wish the paper actually existed, but like you said, I don't think it's actually real.
I doubt it.
It's a great story though. There's John A. List. We had him on Rush Reminder a while ago. He has a paper on, I wish I could remember the details, but it was like people who check their portfolios more frequently tend to take less risk and have lower returns. So kind of speaking to the myopic loss aversion thing. So it's like paying more attention to your investments doesn't seem like a very good idea.
It's funny that you say that because that is a question I tend to ask clients when we're determining or reviewing an asset allocation. So we've been working with a client for a number of years, and I'll often say to them, how often do you check the account? And you get all kinds of answers, right? I get people, I check it every day, sometimes more than once a day. And I get people who laugh and say, I literally don't check it until the day before our review meeting. And I have to think about that, right? Because people who check it every day, and if they have an aggressive asset allocation, then I thought, you must be comfortable with volatility because your portfolio is volatile and you are seeing it. If you have another client who might have a fairly aggressive portfolio, but they never check it, they might actually be quite sensitive to volatility. They just are not, it's not in front of them. And so I think you have to treat those situations a little bit differently. It's not to say that you have to change the asset mix of one or the other, but it is something, I think those are two different situations, right? You have the same asset allocation, but you have a client with a very different approach to volatility and risk.
Yeah, that is interesting. Okay, this next one is generally attributed to Mark Twain, but Dan, you and I were chatting earlier that it's sometimes hard to pin down the actual attribution of these quotes, like who really said it first. Anyway, so this one's generally gets attributed to Mark Twain, but it's sometimes debatable about who actually said it first. The quote is, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." Investing is a discipline that, due to its inherent uncertainty and risk, as we've been talking about, contains a huge amount of noise. It's really difficult to be certain of anything in financial markets, other than the fact that there will be a lot of uncertainty. So I think anytime that you're sure of something, like, real estate always goes up. Um, this crypto token that I found is going to the moon. Tech stocks will always beat the market as they have for a while now, and so on, stuff like that. I think anytime you have that level of certainty, you've got to step back and remind yourself that the only certainty in investing is uncertainty. In addition to discipline and psychological fortitude, I think successful investing requires a good dose of humility and skepticism. If you go all in on a single stock and end up being wrong about it, you could be setting yourself back permanently. It's not uncommon for single stocks, as we talked about in a recent episode, to drop 60% or more and never recover. That's actually a pretty frequent outcome for individual stocks. If you start with a total market index fund and tilt a bit toward something like small cap and value stocks, just as an example, being wrong might lead to a bit of underperformance, but the risk of permanent capital impairment or total loss is minimal. So I think that humility is important, which leads to the last quote that I'll share here. And I know you've got one more, Dan. Harry Markowitz is paraphrased as saying, he never actually said this as far as I could tell, but it's kind of paraphrasing his work. Diversification is the only free lunch in investing. So typically, as we've mentioned, volatility is the price of admission for higher returns, higher expected returns. Diversification is this rare case where adding multiple imperfectly correlated risky assets together in a portfolio can allow you to increase expected returns without increasing risk, or decrease risk without decreasing expected returns. Diversification also mitigates the damage if a single investment in a portfolio does not work out. The downside of diversification, of course, is that it makes it less likely that you'll hit big home runs. But due to the skewness in returns, in individual stock returns, you're far more likely to end up losing than winning with a concentrated portfolio. So to me, diversification is a form of humility, really.
Yeah, it's interesting too that we're kind of finishing with this quote because one of the earlier quotes we had was about how much conviction you need to have in your investment philosophy. And I was almost going to jump in at that point because I'm saying that's true, but part of a conviction is like what is my conviction in our investment strategy, which is, a pure indexing approach. My conviction is that we don't really know anything, right? So it's not so much conviction that I have a lot of confidence in very specific investment choices I'm making. It's almost the opposite. It's recognizing that so much of what we do and so much of the outcomes that we can expect, we really cannot anticipate. And so it's almost a confident humility. I know it sounds silly, but it's really, getting back to what you're saying is just you have to be understanding that because we don't know a lot, the future is unknowable. The only rational response to that is diversification.
Yep.
So I have confidence in diversification, which in and of itself doesn't have a lot of confidence in any specific investment strategy. So
you've got confidence in your lack of confidence.
Exactly. Yeah, I think I've tied myself in knots, but I hope the point is clear.
Yeah, no, it is.
Yeah. So I just wanted to round out with one because I went back when we started to think about, these telling quotes is kind of early on in my investment education, what quotes really resonated with me. And it was John Bogle's book, Common Sense, and the Little Book of Common Sense Investing. One of the first, really approachable books that turned me on to indexing as a strategy. And his quote was, "Don't look for the needle in the haystack. Just buy the haystack," which is just such a great metaphor, I think, for total market index funds. You will always have all of the winners if you buy the total market index fund. And that one has really stuck with me over the years.
Yeah, that's a very good one. Okay, so you got one more after this too, one more quote. But so this was a ton of information. Obviously, we went through a ton of different quotes on a ton of different topics. I think it all boils down to a few key principles, though. Spend less than you earn. Pay yourself first. Keep enough cash on hand for near-term expenses, so you don't have liquidity problems. Invest in a portfolio and invest your long-term assets in a portfolio with expected returns sufficient to meet your long-term inflation-adjusted goals, which is really a financial planning question. It's not one that you can answer just by sticking your finger in the air. You have to really go through and project what your future expected needs are and figure out what asset allocation makes sense for you. Constrained, obviously, by the behavioral stuff we talked about. Choose an investment philosophy and asset allocation that you can stick with, even when they don't seem to be working. I think that point is huge because any investment strategy will go through periods where it really sucks to own and other stuff is doing better, but you've got to be able to stick with it. Like the ARC example, it looked really smart for a while, looked really dumb for a while, but over its full life cycle since it's existed, it's actually done okay. Don't panic when the market drops. Don't chase recent past performance. Don't try to time the market. Maybe those are all saying the same thing in different ways. Be prepared for the future to be different from your current expectations. Be aware of the fees and costs that you pay, and don't be too sure of anything, and diversify broadly.
Yeah, this I did have one last quote here that kind of summarizes all of those things. This is a really great one from Alexander Green's book, The Gone Fishin' Portfolio. And right early in the book, he just notes like, there are several things that will affect your portfolio over time. And those are the amount you save, the amount of time that you give the portfolio to compound, the asset allocation that you choose, your expenses, your costs, and your returns. And if you're listening carefully, you will know all of those are within an investor's control, except the last one, and that is investment returns. And as he puts it, no matter how proficient you are as an investor, you cannot control your portfolio's annual investment returns. And yet this is the factor that so many investors spend their time fretting about. So it's just a great reminder, focus on what you can control. We have zero control over what the market will do, but if we control all of those other factors in the portfolio, that's really all anybody can do. And, if history is any judge, that for the vast majority of people, that is going to work out if you can control those important factors.
Yep. That's a great quote to finish on. All right. So that's the end of our most important quotes in investing. If people are listening and their own quotes that they think we missed in the most important quotes, the set of most important quotes, they can leave a comment on YouTube or look for the thread in the Rational Reminder community that has a bunch of participation already, and we'd love to hear any really good ones that we missed. I like that topic. It was fun to look for those quotes, fun to talk through them, think about why they're important, and kind of relate these fun little sentences that are kind of entertaining to read back to why they're actually so important to good long-term decision making.
Yeah, it really distills a lot of wisdom into a very small number of words.
Yeah, that's right. All right, let's go to the after show. We do have a few reviews from Apple Podcasts to read. We also have a shiny new review disclaimer that I know listeners have been dying to hear. Actually, though, I'm not even kidding. We had comments in the last episode where I said that we had this new disclaimer, but didn't have any reviews to read. People were excited to hear the disclaimer. One of these reviews, the person actually says they left it so they could hear the disclaimer. Okay, so everybody ready? Here's the disclaimer. Under SEC regulations, we are required to disclose whether a review, which may be interpreted as a testimonial, was left by a client, whether any direct or indirect compensation was paid for the review, or whether there are any conflicts of interest related to the review. Now, as reviewers are generally anonymous, we are unable to identify if the reviewer is a client or disclose any such conflicts of interest. So I kind of like that. Like I said in the last episode, that I actually kind of like the disclaimer because like we've never paid for reviews. We would not do that, but saying it kind of feels good. I don't know.
Well, and we've never paid for reviews, but there's no shortage of organizations out there who have done it. I've been asked to do it. You have somebody come over to your house and do a repair, and they're like, "We'll give you 10% off if you post a great review." And I've just said to people, "I'm not doing that." Right? No, I'm like, just charge me whatever you're going to charge me, but I'm not giving you. I mean, if it was an exceptional service, I might give a review just because I believe in it.
Yeah.
But once you start accepting money for reviews, it completely undermines the entire review process. And so, no, I'm not going to participate in that. And glad to hear that we do not here on the podcast either.
No, we don't. Okay, so we got two reviews here. I'll do the first one. You do the second one, Dan?
Okay.
All right. So Levi, who I believe is from Canada, says, amazing podcast and community. Hi, Ben, Cameron, and Dan. Your work on this podcast is absolutely amazing. Thank you. I got to throw in Matt and Angelica and Stephanie and all the rest of the team too. And the podcast consulting guys that do all the audio editing. Okay. Thank you for being the valuable source you are to investors around the world. Truly incredible how many lives you've improved through all of your hard work and dedication. I also want to give a huge shout out to the Rational Reminder community. There are so many wise and intelligent people who are generous and willing to give their advice for no personal gain whatsoever. Would recommend joining to any finance nerds or people looking for in-depth discussions about episodes and many other topics. The Rational Reminder community is it's a cool spot. I like it in there.
Yeah, and very active for sure.
Yeah,
So, and really a very civilized discussion.
it really is. It is
So,
incredible. Yeah,
which is rare, right?
yeah.
Okay, so this one is from Great with Money, who says, spreading financial literacy for the world to hear. I'm leaving a review so I can hear how I can hear the fancy new one digital disclaimer for reviews alluded to in AMA number 8. This podcast has been a powerful tool for leveling up my financial literacy. Thanks to learning about Scott Cederberg's research, I'm 100% stocks for life, at least until the next bear market. Thanks to learning about Andrew Chen's research, I no longer think about factor tilts. Ben and PWL are a mighty pro-social engine for disseminating research-backed financial information into a media landscape centered on vibes.
I like that.
Nice. And sorry about that editorial comment in there.
It was funny. I laughed. Okay, I got a couple quick recent contacts here, and then we're almost done. So Mark Hebner, who's a guest in episode 116, he's the founder of Index Fund Advisors, an RIA in the U.S. He heard us discussing how many indexes are out there. In I think it was in our episode on the case for index funds, episode 347. I think that was me, you, and Mark, Dan. We were talking about how saying that you're an index fund investor can mean a lot of different things because there are so many indexes, many of which look more like actively managed funds than like market cap weighted total market index funds, which is what we're talking about when we say index funds most of the time. So Mark says in that episode that there are around 7,000 indices out there. I followed up saying I think it's a bigger number, but I didn't have the details. So Mark Hebner went and crunched the numbers as he would. He found this is crazy to think about. I'd love to dig into what actually constitutes such a big number, but Mark found that there are close to 1.4 million indexes total, only from the major providers. That's not even including like what are they called? Affiliated indexes, where like a fund manager creates their own index to track with their fund. So this is just from S&P Dow Jones, MSCI, FTSE Russell, CRSP, and Nasdaq, the big ones. So crazy, 1.4 million indexes. So again, saying I invest in index funds doesn't really, we know what it implies, but it doesn't actually have a whole lot of meaning because there are so many indexes. I also wanted to mention real quick, my brother-in-law, who is a Rational Reminder listener, he had a really interesting observation. He listened to the episode with Alex Edmonds, and then he listened to the episode with Martin Kramers, who was talking about why he believes that the conventional wisdom on active fund management is wrong, which is contrary to the beliefs of many of our podcast listeners, including my brother-in-law. So he said that he could feel his brain kind of doing the stuff that Alex Edmonds talked about. Like he feels his brain kind of shutting down and rejecting the disconfirming evidence in support of active management, which was being discussed by Martin. I just thought that was a really interesting observation. And it was not intentional, but it was kind of a neat order to put those two episodes in where Alex kind of equipped people to be aware of what their brain might do if they're presented with disconfirming evidence. And then they got to test it out with the Martin Kramers episode.
Yeah, confirmation bias is something we're all susceptible to. And certainly in the, sort of index investing community, we're all guilty of it too,
Yeah.
right? And that doesn't mean that we won't listen to criticism, but I'm certainly skeptical anytime I hear something that goes against the strategy. Now, that's because there is also a lot of evidence out there.
Right.
But yeah, I mean, it would be foolish to claim that we're immune to that kind of bias.
But I think we're right in having very, very strong priors.
Yes,
Yeah.
that's fair.
Okay, last thing before we conclude the episode here, we do have our Rational Reminder meetups coming up in September. So September 15th that's a Monday. We'll be in Victoria. Cameron and I will be in Victoria. And then Wednesday, September 17th, we will be in Vancouver. I don't think the locations or times are set yet. Maybe the times are, not the locations. I don't know. But there is a form that will be available in the Rational Reminder community and in the YouTube show notes, and we'll post it on our other socials like on Instagram and the Rational Reminder Twitter account and all that stuff. So if you want to participate in those meetups, it's a Microsoft form. Fill it out with your information, and then I guess we're creating an emailing list or something, and we'll let you know the details of the event, like where to go and the time, and whether there's going to be food and all that stuff. Usually there's like snacks and drinks. It's they're pretty fun. It's a big just nerd convention of people that want to talk about the nerdiest stuff you can imagine. But it's for that reason a ton of fun.
Good stuff. Are you going to be at both of those, Ben?
I'll be at both. I'm
Yep.
going to flying out to Victoria, and then Cameron and I are heading. We're both meeting a bunch of people in Victoria, doing the meetup, and then flying over to Vancouver, meeting a bunch more people, and then flying back to Ottawa.
Great.
Yeah, I'll go out a couple of days early to see some family and friends because I grew up on Vancouver Island where Victoria is. So I'll probably go and visit some people before my meetings with Cameron start.
All right, good stuff.
All right, anything else, Dan?
No, I think we're good. Thanks, everyone.
All right. Yeah, thanks everyone for listening.